Are interest rates causing a pause in the Toronto market? Well, that's what we talk about with our good friend Dion Begg. So let's go jump into the studio and see what we got to say. All right, my friends, as promised, here's our good friend, mortgage broker of the world, Dion Begg. How you doing, my man?
Yeah, I guess I travel the world, so I guess I am of the world. Yeah, I'll
There
take
you
it.
go. Yeah, yeah.
Um,
There you go. There you go. There you go. So, what's new, you could say, in the real estate world in Canada? Well, there's been lots new, and maybe mindset has changed, and or perhaps it needs to change, Dion. And we're here, obviously to talk the realities of real estate. And both Dion and I, if you've been following along, we are always 99% of the time the glass is half full. However, things are shifting. Maybe there's been like some people drinking that water a little bit and emptying that cup. So what's going on in your world?
yeah, look, it's true, Gary. So, I mean, the last time we spoke, it was literally a day or two after the Bank of Canada announced a quarter point increase. And I remember in that conversation, I was saying that our clients were still positive, still moving forward. And in fact, some have purchased since then. But the overall sentiment of the general economy and the consumer sentiment, which is the driver of big purchase decisions, has certainly turned. And I think I've been watching your reports, and I've been speaking with some of our realtor partners who have said they've noticed a considerable slowdown with just that quarter point increase.
Yeah. And let's talk about what a considerable slowdown means. It means in the grand scheme of things, if you took that, 50,000 foot view, it's kind of the norm. But when we're used to listing a home today and having an offer date for 5 to 7 days from now and getting, quite frankly, 10 showings a day almost or more, and then you go to maybe one showing a day or two showings a day, that's a huge, almost you feel it in your gut. And really the big picture is, well, that's kind of normal, right? You get
Yeah,
a couple of showings a day or what have you in our world, so it's just a matter of getting used to the new normal is
so
one
in
piece.
the world of sales and listings of properties, there's what we call the balanced market, or the seller's market, or the buyer's market. And what we were in for the last 3 months or so was yet another raging seller's market where the seller was in control. I think even now we're still on the seller's side, just as you said, just not as fast or strong as it was a
Yeah.
couple of months ago.
Yeah. And I still see listings popping up even today. So today's June 22nd, and I'm in Stouffville or York region, and I follow that entire market as well as Toronto's market. We're still seeing some listings pop up with an offer date and things like that. And I talked last week on my market report video that perhaps that listing number, we're going to see that drop a little bit just to attract some buyers to come into the homes. The other interesting thing, Dion, is I always see when we go from one market, one style of market, so a hot seller's market, and where that pendulum swings, sometimes it swings really fast. But in those moments where it's swinging, I think that's the opportunity because people, especially sellers, perhaps are a little bit confused on what to do. And maybe it's a great time as a buyer to take some early action because you perhaps are not competing as you were 2 weeks ago, in a sense, right?
Yeah, and that's actually why some of our clients have purchased in the last 2 weeks. Again, they were competing in what surprising for all of us was yet again another seller's market a couple of months ago. And so because of this, one in particular, just anecdotally, they purchased a property from a family who had already purchased a couple of weeks earlier in that stronger market. And this family realized that they've got a closing date that they must fulfill on the purchasing this new property, which is maybe 30, 40 days out. And they needed to sell their property. And once they saw the interest rate increase, I guess somewhat wisely, they said, you know what, we're not going to mess around. We're going to drop our price and get this thing sold, and so that they could make their purchase. And so our buyer was, I guess, the beneficiary of that pendulum swing that you're talking about there.
Yeah, yeah. And then when a market shifts like this from a mortgage approval conversation and standpoint, Do you feel it's better to negotiate shorter terms, shorter closing dates, so the valuations don't have an opportunity to fluctuate too crazily from the appraisal standpoint? What's some advice that sellers or
Yeah,
buyers can look at there?
that's actually a good point, and I'll give you another real life anecdote. I have a client who has she bought an expensive property, a nice luxury property in Ajax, valued at $3 million last year, and we're in a position where we're wanting to refinance that property, and we actually have the choice to get that appraisal done now, or we could wait a couple of months because the closing's not till September. But our decision was to get it appraised right now, okay, and then if the market was to turn in her favor in the months ahead, we could get another appraisal.
Hmm.
But if the market was to turn in the negative between now and then we can actually use the appraisal that we have secured now. So we're actually making strategic decisions to get properties appraised right now rather than wait. Because look, yes, I mean the writing's on the wall. Interest rates are up, and even though it's a smidge, and even though some of our more rational buyers are getting out there and buying and understanding that's to their advantage, the market what might result in these drops. And so, yes, in a scenario like we are in now, yeah, getting those appraisals done earlier is the best path.
Yeah, yeah. So there you go. If you're a buyer, get that appraisal done as fast as possible, and I would look at close as fast as possible too before some lending requirements might change on you in a sense as well.
Yeah, that's a little bit of a less of a concern in that
Okay.
once we purchase, like, and we get that mortgage commitment, those conditions are set.
Mm.
If after that the lender changes lender guidelines, then it's only new applications where they might change. But that all said, if you have a pre-approval and you're out there wanting to buy, then yes, buying right now might be the way to go. Because yeah, there is some discussion, and you might have read some headlines regarding lending, well, banks having to hold on to a little bit more capital based on OFSI's guidelines. They've increased the capital requirement. Now, that might mean some more stringent lending guidelines down the path. What they might look like as it relates to mortgages and other things are yet to be seen. But yeah, I mean, I can tell you every day in my business as a mortgage guy, every day I wake up, it gets harder to get a mortgage for some
Mm.
reason, be it pricing, be it the government, be it lender guidelines, right?
Yeah, yeah. And and for buyers out there, are mortgages, is there still a lot of products out there for buyers to look at and so forth? Like, has that been pulled back, or there's still lots of products, lots of available mortgages and
Yeah, I mean, the product offering that we have today is fairly similar to the product offering that we had a year ago. The
sure.
key difference is rates are up significantly, qualifying rates up significantly. And so while the product is there, it is exponentially harder to access because of I guess, the qualifying criteria and pricing and other things.
Yeah, yeah. And I know you've got some slides you want to share with us. And before we get to that, I want to ask you, just remind our listeners, if you have a mortgage commitment, is there a kind of a staple of how long that is committed for? When does that expire?
Yeah, that's a good question. So, depending on the lender, it's anywhere from 60 to 120 days, right? So, 90 days is probably the safe number, but it's going to depend on the bank. I can tell you that most deals that come to us are closed well and truly under 90 days. In fact, probably most closing under 60 days.
Yeah.
So those mortgage commitments are good. But more importantly, I guess for people who are thinking about buying, that pre-approval is in fact a rate hold if it's done properly, right? And so if you're thinking of buying, you haven't found a property yet, but you'd like to just secure a rate that is held for a period of time, 3 or 4 months in most cases, then that is something that I would encourage people to explore. There are rumblings about the fact that in July there is the potential for another rate increase. And if you can secure a rate before then at least you know that rate increase won't impact the rate that you're getting as long as you close within the following 3 to 4 months. So if anybody's sitting on the fence, what I would say to you is get that rate hold because it actually costs you nothing. And the way you look at it is it's kind of like an insurance policy. If you buy, then you get this rate. If you don't buy, well, so be it. Just the thing expires and it was a little bit of paperwork, but it could save you potentially thousands of dollars over the life of your mortgage, I guess.
Yeah, no, I think that's a great point. Yeah, if you're on the fence, get off that fence in a sense. Talk to Dion and his team, get that rate hold because I had the suspicion we were possibly going. I think we're going to see an interest rate increase in July, but who knows? Is it this week or next week? I should know this date. The next inflation announcement, that'll be a good indicator of where we go. Meaning, if we see inflation, that number increase, there's a good chance we might see interest rate increase. If it stays the same or a little bit less, then I don't think we're going to see an interest rate change in July. So that's my two cents on
I'll
it.
give you my 1 cent then, if you're giving
Okay.
your two.
No,
All
you give
right.
me 5 cents. I want five.
Around inflation, and we spoke about this last time, that when they measure inflation, they actually include the cost of housing in the measure of inflation. And so, last time around when we spoke, inflation had gone from 4.1 to 4.4, and but if you had extracted the cost of housing and the increase in rent, which was a direct relation to the cost of interest rates, then it wouldn't have been 4.4; it would have been closer to 3.6. And again, I still can't understand why they're still measuring that. It's like I said, it's like throwing fuel on the fire and saying, "Oh, wow, the fire got bigger. I wonder why." Now, for me, that aside, and as much as I want to rant about that, the more important numbers, Gary, will in fact be unemployment. Is the unemployment number growing? And just general growth, CPI growth. Is consumer spending dropping? I personally would be looking at that more so than the measurement of inflation.
Right.
And as a true measure of how the economy is doing, right? And if again, the last time around, those numbers were strong. I would agree that they were strong and strong enough to probably warrant the rate increase that we had.
Yeah, it's good insight. Good insight. Okay, let's transition. I know you've got some slides that you wanted to share with our
Yeah, for
viewers
sure.
and go from there.
Okay.
Let me bring that up and you can get right
So,
into it.
yeah,
So
I
what do
mean,
we got here?
these are some slides that I share with some of our clients recently and many of your clients, many listeners, many realtors might have clients who are sitting on the fence right now saying, you know what, is buying a home even still worthwhile? In today's Canada, in today's GTA, Greater Golden Horseshoe, does it still make sense? And I can totally understand why people are feeling that way. The one thing I would say is that not everybody can buy. Okay, some people have well and truly been priced out of the market. They don't have financial help from family to get them in. But for those of you who are listening who can buy and are just choosing not to buy, and I'm not saying you should run out and buy tomorrow, but what I want to say to you is don't let what's happening now fundamentally change your idea about buying, because there are some very important factors in regards to your long-term wealth around real estate. So this is a report that came out from TD Bank, um, and I think you and I know this very, very closely, Gary. But this idea that wealth used to be, oh, how much money do you make? What's your salary? What's your job? Income is really secondary. It's important, but what's more important is, do you own real estate? In particular, do you own the home that you live in, right? And so it's become clearer and clearer over time, especially with this report. What they did here was they interviewed people in the 10 years prior to retirement, 55 to 65 age bracket. And what they found is that home owners had net worth of approximately 1.4 million, whereas the renters were at just $200,000 in net worth.
Mm.
And I've heard this argument. There's actually a Netflix series at the moment where this guy beats up the idea of owning real estate. He says, you know what you should do, and you and I have heard this, Gary. You should rent, and then you should invest the balance of what you would have otherwise cost you as a homeowner, which is a differential at the moment for sure. But how many people actually follow through on the second half of that,
Yeah.
right? How many of them actually take that surplus of whatever, 500, $1,000 a month, and actually invest it? And ultimately, the home, and I'm going to sound like my father now, a home is a forced way to save, like it's forced savings, right? But it's not just me saying it, it's these national statistics which just ultimately prove that, yeah, okay, if you go and rent and you've given the choice to invest in other things, unfortunately most people don't do that, right? And they end up literally 7 times richer as homeowners than they would as renters.
Yeah.
So again, I mean, now may not be the time for you, but please don't take it off the table altogether as an idea that's important for you and your family. Um, this is another report that came out from a different bank, BMO, where they surveyed another bunch of Canadians. And back in the day, 20 years ago, when I graduated university, it was like, if I could just get $1 million, I'd be gold. Do you remember those days, Gary?
Oh yeah.
Yeah, and and if I had $1 million, then I'd be okay. But even the regular Canadian now realizes that a million is likely not enough to retire. And upon this survey, they discovered that most people feel they need closer to $1.7 million to retire. And some of those people who were in that position in the previous slide that have that house worth 1.4, yeah, many of them might downsize, end up cashing out a bunch. Surely, and we would hope that people have RRSPs and pensions and other things to bolster that, which create the money that they need. But again, home ownership is one big leap in this direction. If this number is true, right? I can tell you, many of my clients don't think that's enough. Many of them
Mm.
think in today's world, 2 to 3 million is probably the number. What are you seeing most of your investors aiming for, Gary?
Yeah, that they want to see that too at the very least. Yeah,
Yeah,
for
yeah.
sure. Yeah.
Okay. And actually on that point, because I used to be a financial advisor before I got into real estate and realized real estate made more sense. Most people work on this 4% return, right? If I invest this amount when I retire, if I could just live off 4%, hoping that it would generate 4%, then could I live off that? And so I guess back then at $1 million, that was 40 grand a year. And if you had no other debt, you'd live a good life,
Yeah.
right? Today, I think even with no other debt, I think we all know 40 grand a year is likely not enough to sustain a lifestyle where you're enjoying your retirement, not just clipping coupons and eating baked beans on toast. That's what we would do in Australia.
Yeah, we would hear, and any English influence, we definitely would too here. Yeah.
Yeah, but yeah, all that to say, Gary. I mean, we've got very good reason to continue to invest in real estate. It's exponentially harder than it was years ago. I acknowledge that. But if you are in the category that can, then I think you should. And yeah, talk to your parents about them. And again, Gary, you and I both have parents who invested in real estate over time. And I know the interest rates of 30, 40 years ago
Hmm.
were up around that 12% number, depending or I recently saw a video. Actually, I should share it with you, and you should share it with your group. Where there was a CBC news report, I think it was CBC, where they're saying, okay, yeah, today's interest rates are 17%,
Yeah.
and people were still buying in that environment. So it's not going to get much easier over time. It's always, in my experience, gotten a little bit harder in the last 15 years in particular. But if you can, I think you should figure out a way to move forward. It doesn't have to be now, but certainly in the next year, watch the market and be prepared to take those advantages of what might be presenting with that pendulum swing.
Yeah. Yeah. And we've said this before. I know for some it might sound like a broken record, but maybe you weren't in a position to listen to it, or you're new to the channel. Dion and I both talk about, live where you want to live, meaning if you can't afford to own a house in downtown Toronto where you need, rents are creeping up to that $4,000 mark and everywhere else, or you got to spend 1.5 to 2 million to get into a home, it doesn't make sense. Buy an investment property where you can afford, and there's many outlying areas that still have good fundamentals, and you can start to obtain some of that equity and wealth that Dion's talking about. We've done it many times for our clients.
You
Look
know,
in
I
those
just wrote
outside markets.
I just wrote something about this in particular. So these numbers are kind of fresh in my mind. So let me share with you. At the moment, it looks like around 11% of the population are property investors,
Hmm.
right? But the survey that came out from Roy LePage said that 15% of those who own property, real estate investments, do not own the home they live in, right? So
Yeah.
in line with what you're saying there, what we're talking about, guys, are people aged between 18 and 34. They're either living at home or they're renting. but they've decided that during that period of time when they're in that living at home or renting, they're still going to get their foot on the property ladder, and they're going out and they're going to go buy. And a perfect example of this was just a couple of years ago. It was in fact a realtor. I helped a realtor's 21-year-old son buy a property, uh, and in a matter of 2 years, it increased in value by over $300,000. He then sold that property, gave back the gift that his parents had given to him, and said, "I'm going to keep my 200 something thousand, go off and do his own thing." So again, a lot of people can utilize that time while they're waiting to save. And again, traditionally that saving is GICs and TFSAs and those types of things. But imagine saving in a piece of real estate that builds equity in regular times.
Yeah. And I get it. I get it. All the naysayers, well, he bought at the right time. He did this. No, what he did was he took action, right? And that's the big piece. And there's areas like, one of my video partners, a broker owner in Calgary. There's opportunities in Calgary. If you want to go to the East Coast, there's opportunities in the East Coast. And of course, if you're right here in Ontario, look at some of those outlying areas. You look at all the properties. We've talked about this before. All the properties that I've ever owned, none of them. They kind of form a nice golden horseshoe around the golden horseshoe, right?
Right. Yeah, and that makes sense. Yeah.
Yeah.
The outer rings are still where we're still having clients find property that does make sense. Some of them are still doing the conversions where they're putting in that basement apartment. And more so now than before, the establishment of that ADU, that accessory dwelling
Yeah.
unit in the backyard, the garden suite, we're seeing more and more of that come online as well. So yeah, and again with the densification that we talked about in Toronto, it's likely going to roll out to those outer neighborhoods as well.
Yeah. Yeah. Okay. So that's the future. That's how you should be taking care of your future, and only you can control your future. That's the way I see it, and Dion sees it. Uh, Give us that quick synopsis before we sign off. For mortgages, what are you seeing right now? Obviously, it's harder to obtain a mortgage, but banks are still willing to lend. That's what I'm hearing, right?
Yeah, I mean, look, it's just again, I said the products are still there. It's just the qualifying criteria is harder simply because the qualifying rates are higher.
Hmm.
So if you're right now looking for a high ratio mortgage, that is, you do not have 20% down, you're a first time buyer or a second time buyer, you're buying a principal residence with less than 20% down, those rates, which a couple of weeks ago were in the mid fours, 4.5, are now closer to 5. Okay. And for those of you buying at with more than 20% down, conventional type loans, those rates, which we could have secured closer to early fives, 5.2s, are now up around the 5.6, 5.7, depending on the institution and your overall situation. So yes, the movement has increased. You know, that quarter point was somewhat built in to some of these lenders, but we have since seen more since June 7. So we've probably seen about a 0.5% increase over the last 4 weeks.
Yeah, yeah, and I know we've seen some of the bond rates go up a little bit, which affects the mortgage rates. We won't get into the weeds of what that is, but keep tuning in to our videos here, and then we'll keep you up to date with what's going on. Dion, how do people get a hold of you?
Yeah, just look me up online, guys. The company is mortgagesbydion.com. Feel free to reach out with any mortgage questions. Just look me up. Also on Facebook, Dion Beg, Dionbeg.
There you go. Pretty easy. All right, my friends, that's our video for this week. We'll see everyone on the next one. Goodbye for now.
See you, guys.